So you're looking now at an image that shows economic data for the year 2022, as well as for the first month of this year, January. And if you look at the economic variables, you have oil prices, you have the inflation rate, you have the Fed that adjusts the interest rate and did so on different occasions last year. If you look at each point here where decisions were made, you'll also see the price of oil that corresponds to that decision date, as well as the inflation rate. For example, going through the dates here, you see January, no move was made as far as the rates were concerned. And oil went from 85.96 to 99.38, then to 106.74, 112.70. And in the midst of this period, you had the Fed adjusting the rate by 25 basis points on March 17th, and inflation and oil laughed at it. Then you get to May, and they step it up to 50 basis points. And once again, inflation, 8.6, which is higher than the 8.5. And your oil, 106.74, which is higher than a 99.38. Both of these guys are laughing at the 50 basis point increase. You get into June, by that time, oil is at 112.70, and you've got inflation at 9.1. What does the Fed do? They step out, 75 basis point hammer drops. And there is the desired response or reaction. What happens? You see oil drop from 112.70 to 95.29. Inflation goes from 9.1 to 8.5. And that's a trend that continues to go forward. By the time you get to September 21st, you have oil at 82.43 and the inflation rate that stepped all the way down to 8.2 from the previous high here in June of 9.1. So you have a definite trend of inflation going down and oil prices going down. And so the 75 basis point hammer being dropped was precisely what was needed. You get to December, and the decision is to go with 50 basis points instead of 75. By that point in time, however, the inflation rate had dropped to 6.5, so it seemed a reasonable move to not continue to drop that 75 basis point hammer. And also your oil was at 77.33. So you have a definite trend that's established once they drop the necessary hammer, once the necessary medicine and dose of medicine is given to the economy. Moving forward into January, however, we see an interesting pattern that starts to shape up, which is a little troublesome. You have inflation, which is still low, but really, if you think what the target is, 2.5%, 3%, I mean, you're still more than twice what the target is. But it's responded well. It's gone down. But it's interesting because there's the undercurrent of oil prices, which of course isn't being eyed as, how can we say, with the same amount of interest as you would the inflation rate, but it is an undercurrent that definitely affects the inflation rate. So one must keep an eye on that also. If you look at the chart down here, you're able to see where the December low was 71.43, and that was on the 9th of December, just a few days before the Fed stepped out on the 14th and gave the 50 basis point decision. And what you're seeing here is a trend of higher lows, which could continue to carry oil prices further up going forward. And if that happens, of course, that's going to have its clear pressure on the inflation rate. So to step out with a 25 basis point move for February 1st probably was too little too soon. And by our estimation, was premature.